Welcome back to the ProTicker Podcast, your Thursday morning edition covering major financial magazine headlines, everyone. It's July 24th, 2025, and if you've been keeping an eye on the financial world, even just casually, you know it's a particularly charged moment. Headlines are just flying everywhere, and the market is, well, it's reacting constantly. Here on the Deep Dive, our mission is basically to cut through all that noise, pull out the most important nuggets, and give you a solid understanding of the forces shaping global markets, corporate strategies, even politics right now. We're pulling our insights from recent pieces, reports from places like CNBC, Bloomberg, Yahoo Finance, all fresh stuff, covering events from just yesterday and today, July 23rd and 24th. So, yeah, get ready for a conversation that mixes the big picture with some, memorable details, hopefully those aha moments that make it all click.
It really is a fascinating time. There's just so much happening, and we've got quite a bit to unpack for you today. From these high-stakes political moves affecting the Fed to AI's huge impact, sometimes good, sometimes disruptive, and, well, just how the market's feeling day to day. It's all connected.
Absolutely. Let's jump right in. First up, the political economic dance. That's what we're calling it. White House, Federal Reserve, and global trade. Okay, so the big headline today, CNBC is reporting on this, President Donald Trump's scheduled visit to the Federal Reserve. Now, this is a big deal. It's the first time in almost 20 years a U.S. president has officially visited the central bank. Symbolism here is, well, it's pretty heavy, right? Especially given the whole tradition of Fed independence.
That's exactly it. This visit, and both CNBC and Yahoo Finance are pointing this out, it's seen as a real escalation of President Trump's ongoing pressure on Fed Chair Jerome Powell. The president's been very vocal, hasn't he? Arguing Powell's done a bad job, should have cut rates, not held them steady. He's even talked publicly about firing Powell, which naturally makes investors nervous about the Fed's autonomy. This kind of direct engagement, it really pushes those unwritten boundaries around central bank independence. It could set a precedent. Investors have to factor that risk in now.
Right, factoring it in. So how are the markets actually reading this direct political spotlight on the Fed? Any immediate shakes? CNBC mentioned Treasury yields nudged up a bit today, the 10-year yield up 1 basis point to 4.4%. So investors are definitely watching closely, maybe bracing for something.
Yeah, well, it definitely raises questions about confidence in the Fed's autonomy. That slight move in yields suggests a kind of nervousness. Treasury Secretary Scott Bessent tried to calm things down yesterday, saying there's nothing that tells me that Powell should step down right now. But, the president actually going there keeps the pressure on. It's not just about rates anymore. It's about the Fed's credibility itself.
And it's not just monetary policy getting this attention. Yahoo Finance highlights this related fight brewing over the Fed's massive $2.5 billion building renovation. Trump allies are apparently taking their complaints right to the building today with a tour. What's the bigger game here with this renovation issue?
Yeah, it's interesting how this cost overrun thing has become another political lever, hasn't it? Allies like James Blair, he's new on the National Capital Planning Commission. They're publicly questioning the cost jump $1.9 billion up to $2.5 billion. Now, the Fed defends it, citing material costs, unforeseen conditions like asbestos, toxic soil, things you find in old buildings from the 1930s needing their first big overhaul. But as Yahoo Finance noted, this isn't just about the money. It links to a bigger push for an exhaustive internal review of the Fed. Treasury Secretary Bessent actually called for this. It signals they want to look at the Fed's non-monetary roles, address potential mission creep. It feels like an attempt to reshape the Fed's function beyond just Powell, maybe limit its scope long term.
Wow, yeah. A clear example of politics and economic policy mixing. Okay, let's smoothly shift gears from the Fed to global trade. We're seeing some major moves on tariffs. President Trump's now talking about reciprocal tariffs, possibly ranging from 15% all the way up to 50%. That's a big jump from the 10-15% range mentioned before. Yahoo Finance flagged this as a more aggressive turn. What's the thinking?
Well, connecting the dots, this tougher talk fits with the administration's broader strategy, pushing for new trade deals they see as better for the U.S. There's been some optimism, for instance, about a U.S.-EU deal, especially after the U.S. signed that massive deal with Japan. CNBC and Yahoo Finance covered that. That Japan deal had a 15% tariff, yes, but also brought in, $550 billion in U.S. investment? And there are reports, citing the FT and Bloomberg via Yahoo Finance, that a 15% deal for the EU might be close. Analysts see that as, significant but not devastating, especially compared to that 30% threat hanging over August 1st. 15% is still a hit, mind you.
Okay, but maybe manageable for some. But it's not all smooth sailing, especially for consumers, right? Thinking about everyday stuff. CNBC had this story about Diallo, the big Spanish olive oil producer, warning about a double whammy for U.S. consumers if that 30% EU tariff threat becomes real. What does that actually mean at the checkout?
Yeah, this really brings home the direct supply chain impact. About 95% of the olive oil we use in the US is imported, mostly from the EU. So a policy like that, it means higher prices, maybe less availability, hitting consumers directly. Diolio told CNBC access to a staple like olive oil should not be penalized. Makes sense, right? Imagine a 30% price hike on your cooking oil overnight. That hurts. And CNBC mentions similar worries from Irish whiskey makers, Italian cheese producers, French wine folks. It shows how wide these tariff impacts can spread.
But then there are these unexpected twists. Like CNBC also reported the 50% tariffs on aluminum imports are kind of accidentally sparking a green recycling boom here in the U.S. That's fascinating.
It really is a remarkable side effect, absolutely. As that CNBC report laid out, recycling aluminum takes only about 5% of the energy compared to making new aluminum from scratch. Much greener. So these tariffs, they've created a strong economic reason to boost domestic recycling. It might even flip trade flows. The U.S. usually exports scrap metal, but now might import more scrap just to feed these recycling plants. So you get improved self-reliance in aluminum, and it's better for the environment. A kind of win-win nobody really planned for. Shows how complex these policies can be.
Definitely complex. And how are these tariff jitters playing out in other really key sectors, like, say, semiconductors? They're vital.
Right. SK Hynix, they're huge chip makers, supply NVIDIA. They noted, according to CNBC, that all this tariff uncertainty actually boosted demand in the first half of the year. Companies were stocking up. But now they think sales might dip in the second half because everyone bought ahead. And partly in response to these global pressures, South Korea just announced a massive, 33 trillion won support package for their semiconductor industry. It shows countries everywhere trying to protect these critical sectors, make sure their supply chains are secure. It's a global trend.
A huge government intervention there. Okay, let's pivot now into corporate fortunes and market trends. Seeing how these bigger forces hit specific companies, especially in tech. So Alphabet, Google's parent, they beat earnings expectations for Q2, according to CNBC and Yahoo Finance, and they're doubling down on AI spending. Stock went up. What's this signal about the AI race?
Well, what's really striking is just how fast AI is not just affecting industries, but actually changing core strategies. Alphabet's strong results, even while spending tons on AI, tells you the market buys into that vision. And look at SK Hynix again. CNBC reported record Q2 profit and revenue for them. Why? Mostly massive demand for their high bandwidth memory, HBM, which is essential for AI. They think they'll double HBM sales this year. It made up, 77% of their Q2 revenue? That's huge. They're even planning mass production of the next generation HBM4 for even more powerful AI.
So SK Hynix is right there powering the AI memory boom. But how's AI changing, more traditional giants like retail Walmart?
This is where it gets really interesting. Walmart, the biggest retailer, just announced plans. Reuters reported this for what they call super agents using agentic AI. Basically, AI that can act on its own with minimal human input. They've got names like Sparky for shoppers, think personalized help, easier buying, Associate for employees boosting productivity, and Marty for suppliers optimizing logistics. The goal: boost e-commerce, streamline everything, and hit a target of 50% of their sales online within 5 years. That's not just treating things, it's a fundamental shift in how they operate.
50% online.
Yeah.
Wow, that's huge. But it does raise that question, doesn't it? The human side. Walmart suggests AI will create new jobs, but Reuters also mentioned those big AI-related layoffs at Amazon, Microsoft, Google, thousands of people. Is it possible the job creation won't keep up with the displacement, or is this just, short-term pain?
That is the billion-dollar question, isn't it? It really shows the two sides of AI. Incredible efficiency and new possibilities, but also very real workforce changes. The long-term outcome, still unclear. But right now, it looks like being adaptable, learning new skills, that's going to be crucial for workers as industries make this shift. Its attention we'll definitely be watching.
Okay, switching gears again slightly, let's look at the EV market. Tesla seems to be hitting some bumps. Yahoo Finance and CNBC both reported they missed Q2 earnings and revenue, and Elon Musk himself warned about a few rough quarters coming up. What's going on with the former king of EVs?
Well, if you zoom out, Tesla's issues seem to be part of a bigger shift in the EV world. Losing those federal tax credits here in the U.S. definitely hurts demand. But it's global, too. In Europe, CNBC noted their market share dropped for the 6th month straight in June, down to 2.8% from 3.4% last year. Registrations fell almost 23% year on year. So it's not just one bad quarter. It points to tougher competition, maybe a market that's maturing past those early adopter subsidies.
And it's not just Tesla struggling over there. CNBC data showed overall European car sales actually fell 5.1% last month. Big names like VW and Stellantis saw drops too. What's behind that regional slump?
It's definitely a tough climate for the established players. Fierce competition is a huge part of it, especially from those fast-growing Chinese brands BYD, Leapmotor, XPeng. CNBC data showed their combined market share in Europe nearly doubled in the first half of the year, hitting 5.1%. They often offer cheaper cars with good tech. That puts pressure on everyone else. Plus, those U.S. tariffs of 25% on Chinese EVs influence where those cars get pushed globally. Some analysts, according to CNBC, are even whispering that Tesla might become more of a niche brand if they don't come up with some really big new tech soon. Not the leader, just one player among many.
And that slowdown hits suppliers too, right? Like STMicroelectronics. Bloomberg reported they get a lot of business from AutoWay. Tesla's a big customer, maybe 6% of their revenue. They posted a surprise loss, gloomy outlook.
Absolutely. STMicro's situation just highlights how linked everything is. When a big industry like auto slows down, especially somewhere like Europe, it hits the suppliers hard and fast. Affects their earnings, their forecasts. It's a chain reaction.
Okay, so we've got these mixed signals from companies, some doing great, some struggling. But the overall market, the S&P 500, has soared 28% since early April, hitting records routinely, as Bloomberg pointed out. Yet you have big firms like Goldman Sachs, Citadel Securities, telling clients to buy cheap hedges against possible slides. Seems contradictory. What's the thinking there?
Yeah, it's that contrast that's interesting, isn't it? What those big firms are saying, according to Bloomberg, is basically, yeah, things look calm now. The VIX, the fear gauge, is low, but they see potential bumps ahead. The Fed decision next week, July 30th, Trump's tariff deadline August 1st, the July jobs report, more big tech earnings, lots of things that could shake the market. So they're not yelling fire, but suggesting clients buy volatility, basically get some insurance against sharp moves. Some even mention September is often a rough month for stocks historically. It's about being prudent, even in a bull run.
Prudent, but that hasn't stopped the meme stocks from coming back, has it? Yahoo Finance and CNBC are talking about a summer of 2025 for names like Opendoor, Kohl's, Krispy Kreme, even American Eagle jumped. Feels like 2021 all over again.
It does have that feel. The general mood, according to analysts quoted in Yahoo Finance, is that investors are feeling somewhat invulnerable. It's a risk-on vibe, still driven by that belief in the AI story. I mean, Opendoor stock jumped over 300% in just the last month. That's wild. We're also seeing more activity in SPACs, those blank check companies, and lots of call options being bought, people betting heavily on prices going up. It definitely shows retail investors are jumping back into riskier plays.
Okay, it definitely sounds like 2021 with GameStop and AMC. What are the warnings this time around for individuals getting caught up in this?
Right. And this really raises that critical question about sustainability, especially for individual investors. Strategists told Yahoo Finance that while the pattern looks similar to 2021, these new meme stock rallies seem to burn out faster, a shorter half-life. The biggest warning is pretty stark. It could all end tomorrow. And this kind of retail frenzy often happens near short-term market peaks. There's also that study Yahoo Finance cited. 57% of Americans admitted making a bad financial choice based on online info, and 18% lost over $1,000. It's a serious reminder of the risks when things get this speculative. Quick gains can vanish just as fast.
So we've covered a lot of ground today. That interplay between politics and the Fed, the sheer force of AI changing industries, those global trade shifts with their surprising effects, and, the whole psychology of the market, from caution to speculation. It's clear all these pieces are moving together, creating this really complex picture that's, frankly, pretty crucial to understand if you want to stay informed.
Absolutely. Every single element we talked about, the Fed's independence challenge, the tariffs impacts, AI adoption, market sentiment, they're all intertwined and actively shaping the economy we're navigating right now. Understanding it isn't just for finance geeks, it's about grasping these fundamental global shifts.
So here's something to think about. As AI keeps accelerating, changing everything from retail to manufacturing, and as trade policies keep shifting, how might this push for national self-reliance? Things like aluminum tariffs or government money for chip makers. How might that change global competition and innovation down the road? Are we heading towards more resilient, diversified economies? Or maybe more fragmented, less efficient global markets? Definitely something to mull over.
Yeah, this deep dive today really just scratches the surface of these huge forces and what they might mean long term.
We'll see you all tomorrow morning with new headlines from major financial magazines.